Moving averages are another indicator in this series of tools used by chartists when trading in the stock market. Even if you've been trading for a while, these simple and short refreshers can really help. I'll only cover two basic and commonly used moving averages today in the video, but there are many different types. So yes, we know what the term moving average means, obviously, but let's just think about the definition. Moving averages are very commonly used by technical analysts to help smooth out the price action and all the unwanted noise from random and normal price fluctuations like you see here. A moving average is a trend following or lagging indicator, and that's because it's based on the past prices. So the two moving averages we'll discuss today, the main one we'll discuss is the simple moving average, which is the simple average of a security over a defined number of time. And then, briefly we'll just touch on an exponential moving average, which gives a bigger weight or importance to the most recent prices. The most common applications of moving averages are to identify the trend direction and to determine support and resistance levels, which we'll cover all of those. While moving averages are useful enough on their own, they'll also form the basis for other indicators like MACD, which is moving average convergence divergence, which is also the next indicator we'll cover in our series. So simple moving averages are derived by taking the average closing price as defined in the settings of the moving average. So let's take a quick look at this example to make sure you understand. We'll simply add the closing price of the last 9 periods. So we're on this period. How did this line get here? Well, we'll add these last 9 periods, which we're on an hour chart, and we're using a 9 moving average, so that's why we're going to do 9. So this is the last 9 hours. Where did they close? We'll add all of those together. That'll give us it'll give us 18,140.9. You divide that by 9 to get the average, and you'll get somewhere around 2015.7 as the moving average to start the next candle, which is shown here. I mean, that's pretty good. So that's how this line is derived. It changes depending on if you're on a daily chart, it'll be the last 9 days. If you have a 50 moving average, it'll be the last 50 periods. Moving averages, like I said, they lag the current price action because they're based on the past price action. So therefore, the longer the time period for the moving average, the greater the lag. So this would mean like the 200-day moving average as seen here will have a much greater degree of lag than a 20-day moving average as seen here. And that's just because this 200-day moving average contains prices from the last 200 periods. So here we're looking at a daily chart for the S&P 500. You'll see that the 20 moving average turns upward right here. This isn't 2009, pardon me, so this isn't the real estate bust, but it starts to turn upward 158 days later, which is interesting. It's a 200 MA, and this is a 20, so that only leaves 20 days off, maybe, that we had some really exuberant movement. But then finally, the 200 moving average turns upward to meet. And that's followed by a bullish cross, which we'll also talk about shortly. And it's also followed by a bullish crossover or buy signal from the price action, which we'll also cover shortly. The length of the moving average to use for different traders really depends on your trading objectives. I mean, the shorter moving averages are used for short-term trading, and the longer-term moving averages are more suited for long-term investors. So we'll take a look here. This is the same S&P 500 chart that we'll look throughout this video, but a longer-term investor, we'll look at the day. We're looking at a daily chart here. They would have taken an entry position here, and they would have stayed in that trade all the way down to here and then taken an exit when this started to move up. However, if you look at the exact same time period, at the same time frame on the daily chart, But with a shorter moving average, for say maybe a day trader, they would have taken 5 trades total throughout this period. And pardon me, that's a swing trader. The other is a long term. This would have been a swing trader. It would have been 5 trades, and fairly long trades even. But there's no reason to get out. Looking at a good indicator like this. So I do want to iterate the importance that the 200-day moving average is widely followed by investors and traders. Alike. With breaks above and below this moving average, it's considered to be important trading signals. So you'll see, like I was talking about earlier, the price action moves through this 200 moving average here. It moves down from above. That's a bearish move, and that's a sell. If you were holding something long if you were holding a long S&P from over here, you would want to sell here. And if not, or if you wanted to go into a short position, this would be the point. So this is your sell or short signal. And then here you'd want to buy for a long-term hold upward with the trend change, and or cover. If you shorted here, you definitely want to start covering here, because this price action moving through this moving average, moving up from the bottom is bullish, and it's going to cause this moving average to have to turn. So I'll give you a little heads up. Moving averages are also important trading signals on their own. So when 2 moving averages cross over, that's a different signal. A rising moving average indicates that a security is in an uptrend, as you can see here, and a declining moving average indicates it's in a downtrend. So this was the short signal that we got from the price action crossing over the 200. You'll see here that the moving average is definitely pointed down, and price action is also in a downtrend. There again, we see the buy signal or the long bullish crossover from price action to 200. Next thing you know, the moving average of the 200 is pointed up, and price action is also in an uptrend. I was talking about moving average crossovers being signals a second ago. This is how you can confirm the momentum that you're seeing. You're seeing this downward price action momentum. You need to confirm it somehow to be sure. So downward momentum can be confirmed with a bearish crossover, and that'll occur when a shorter moving average crosses under a longer moving average. So we have a great example here on the same chart. We'll see the 50 moving average here in green cross from over underneath the 200 daily moving average. And that's definitely that confirms this bearish momentum is going to continue. And lo and behold, if you draw an arrow, a line, from that bearish cross to the next bullish cross, it's down. To the next bullish cross, excuse me. Then down here we see the bullish crossover, which signals the trend change again. Or the momentum is changing for this, and the trend changes with it. So we see the buy signal that we saw earlier with the price action moving through the 200. We see the 50 moving up through 200, which is called the golden cross. This is a death cross, by the way, if you've heard that term, which you likely have lately. And this confirms this bullish momentum. We'll see this price rise after this. Also, we talked about moving averages providing support and resistance. Here's an example of, now I have multiple moving averages turned on here, but here's an example today, actually right now while I was making this video, of the 200 moving average providing support. Now I use the 200 a lot just because it is a primary tool used by almost all traders. But myself as a day trader, I like to use shorter moving averages as well for entries and exits throughout the day. But here today you could see that the S&P was using the 200 as support. Hit the support and bounced up and ran a little, came down, and it pushed through but didn't hold. It's kind of like there are all these sell orders went in. As soon as everybody realized it was past the 200, which is where they intended to stop, it went back up. So that provided support there. Came back down and bounced one last time, and then Miss Yellen came on shook the market good. Here's a good example of the 200 moving average providing resistance. And this was earlier in the month. So we have the 200 moving average on top. This is in bearish fashion. The fastest moving averages are below the longer moving averages. And you see here, it came through with price action, it hit and bounced down, hit and bounced down. Finally decided to come back up and try again, but no, resistance was too tough. The 200 provides pretty good resistance and support level for most equities. Well, thanks for joining me for this short refresher on moving averages. If you enjoy this and the other videos in this series, please feel free to send your friends over or come join us at Gray Trading School. You can sign up at our website for a noise-free, friendly, and productive environment. Take the 5-day free trial and come learn, trade, and share charts with all of us. Appreciate it. Thanks.